Two guys start on the same trading desk the same Monday. Same screens, same boss, same starting pay. 10 years later, one of them is clearing 7 figures a year trading crude oil from a beach house. The other one got walked out by security and now sells insurance. Same desk, same start. Forget the movie version. No screaming, no hand signals on a floor. A real commodities desk is 40 people in a quiet room, staring at terminals, moving cargo across oceans without raising their voices. Quieter than you'd think, and far more brutal. Before I tell you what split those two guys, guess. Keep your answer in your head, because one 4 a.m. phone call, the bank demanding more cash against your position or it gets closed, can erase 10 years of being right. So today, we climb every level of the commodities trader, from the kid logging tanker positions before sunrise to the owner who takes a cut of every barrel that moves through his house. Your job watching this? Find the rung where the money stops coming from your hours and starts coming from what you own. Mine is to make sure you see the trap before you step in it. Let's climb. You're 22, you sent your resume to Trafigura, Vitol, Glencore, names your college roommate has never heard and never will. You got the seat because you were hungry, and your mental math was fast. 55 grand, maybe 60 in an expensive city. This is the bottom rung, and most people who ever touch this business never leave it. The cost is your mornings. You're in at 5 a.m. because Europe is already trading, and the overnight numbers have to be printed before the senior traders walk in. You track vessel positions through the Strait of Hormuz, the shipping lane a fifth of the world's oil squeezes through. You log refinery outages. You are data, and nothing else, yet. What it buys you is a front row seat to how the money actually gets made. Watch this. The senior trader glances at your analysis for 90 seconds, then makes a call worth $14 million. Your name is not on that call. Your work is in every number on it. Sit with that, because it's the whole video in one image. You do the work, he owns the decision and the upside. And what it says about you? That you're coachable and you can survive being ignored. At this level, your income is pure hours. Stop showing up, the money stops the same day. You're 24. You get a book. A small one. Yours. You're trading refined products, diesel and jet fuel, the boring liquid stuff, capturing small gaps between Northwest Europe and the Mediterranean. 120 grand base, and for the first time, a bonus, which means your pay isn't only about hours anymore. It's about a number you produce. The cost? Your nervous system. You carry real risk now, and one bad afternoon can erase a good month. What you get back is the first real taste of owning an outcome. And here's the shift that matters, the one almost nobody makes. At level 1, you sold hours, so your ceiling was nailed shut. Now you've got a P&L, profit and loss, the running tally of what your trades made or lost, and that ceiling just turned elastic. Same desk, same building. The variable changed from your time to a result you own a piece of. Most people never make that jump. They get comfortable as runners and cap out. You don't. What it says about you now. You're a number on a report, and numbers get cut. The higher you climb from here, the harder the fall. That part's coming. You're 27. Now you run a real book. You're not just clicking the front month anymore. You're trading spreads, betting the gap between this month's oil price and next month's widens or narrows. 300 grand base, and in a strong year, the bonus doubles it. The year after, the market goes quiet, and the bonus is a fraction of that. Lumpy. Your pay is the volatility now, not a salary. The cost is that you stop being fully present anywhere. A storm in the Gulf of Mexico can move your position 6 figures while you sleep, so part of you is always at the desk, even at the dinner table. You take the 2:47 a.m. call in the kitchen so you don't wake anyone. What it buys you is the edge. Not data, everybody sees the same screens. The edge is knowing which seller has to move volume before quarter end, which buyer has a refinery outage he hasn't announced yet, where crude is really flowing from West Africa to Asia. And here's the take that annoys people. You've stopped being managed and started being measured. Measured people get rich or get fired, nothing in between. And here is exactly where our two guys split. Same rung, same pay, same book. One spreads his risk and survives the boring years. The other, hungry for the bonus, leans his whole book into one giant bet on natural gas going up. He's about to learn what happens when you're right about everything except the timing. You're 32. This is the dip. This is the night you'd have quit, and most people in this seat do. Your big natural gas bet is correct. The fundamentals say the price should rip. But the market does the one thing it loves. It stays wrong longer than you can stay solvent. You hedge the position with paper, with futures contracts, and now that hedge is bleeding cash daily. The price drops first. Your margin call hits at 4 a.m. A margin call. Post more cash against the position or they close it for you. You don't have it. They close it. By the time the price finally rips the way you called it, you're already out. The account is zero, and security is walking you to the elevator with your things in a box. Be honest right now. This is the level where you'd have taken any safe salary on earth just to make the fear stop. So here's the answer to the guess I asked you to hold. It was never intelligence. Both guys were smart. What split them was position sizing. Being right is worthless if you can't survive being early, and nobody's timing is good enough to bet their survival on it. What this cost you was everything. What it bought you was the only lesson that compounds. Survive first, win second. And what it says about your money is the ugliest line in this whole video. The market doesn't pay the smartest person in the room. It pays the last one still standing. You're 35. You climbed back. Different firm, smaller seat, but you came back carrying the lesson the blow-up burned into you. Now you're a portfolio manager at a fund. $750,000 in base, plus a cut of the profits you generate, which is where the real money lives. The cost is that you carry other people's money now. When a junior on your desk makes an error, the loss flows through to your number. That weight never fully lifts. What you get is the percentage. Not a salary plus a tip for a good year, an actual slice of the upside your trades create. You used to sell hours, then results. Now you sell your judgment, and you keep a cut of everything it makes. Still standing, barely, but standing. And here's the take that'll annoy people. The $750,000 PM everyone calls rich is still just renting. He rents out his own judgment by the year. Miss 2 years and he's gone, same as anyone. That's not rich. That's well-paid rent. There's a level above where the money stops depending on you being right about the market at all. You're 41. This level surprises people, so guess where the money comes from before I tell you. It doesn't come from calling the price right. It comes from moving the actual barrels. You work for a house that handles the physical stuff. Cargoes of copper, tankers of jet fuel, real crude crossing real shipping lanes. Finance moves paper. You move molecules. $3 million in total comp in a good year, and the elite tier clears far more. In a bad year, a lot less. The cost is a life lived across time zones. Your counterparty is in Singapore at 3 a.m. your time, and your cargo loads in Nigeria today, but won't discharge in China for 6 weeks. The price moves, the freight moves, the credit risk moves. You're trading time as much as molecules, and that gap is where the money lives. This is physical arbitrage. Buy it cheap here, sell it dear there, pocket the gap. And here's why it beats the screen trader. You're not betting which way the price goes. You're capturing a gap between two real places. But that gap is not free money. It only lands if a chain of things all hold. The refinery loads on time, the vessel arrives, the quality meets spec. The buyer accepts delivery. The bank releases its letter of credit, its written promise to pay once the documents are in order. The freight rate doesn't spike between booking and loading. One link breaks and your spread inverts into a loss. Get that chain right year after year, and it's the closest thing to a toll booth in this whole game. A toll booth with a maintenance crew, but a toll booth. What it says about you. You stopped betting on prices and started owning the flow. And the man at the very top owns the road. You're 49, top of the ladder. You don't have a book anymore. You have a fund, or you have equity in the trading house itself. In a year like 2022, when the whole sector printed money, the best owners cleared $50 million and up. Most years, it's a fraction of that. And in a bad year, the firm's capital, which is now your capital, can run the other way. The cost is that your name is the risk. When your traders blow up, it's your money and your reputation in the headline. Their mortgages depend on your performance. What it buys you is the only thing that ever actually mattered on this whole climb. You don't get paid for your hours, your results, or even your judgment anymore. You get paid because you own the machine that produces all of it. The traders downstairs are still selling their time and their nerves for a cut. You take a piece of every trade they make in your sleep, whether you show up or not. The runner makes money when he shows up. You make money because you own the place he shows up to. Same desk where you started. You just stopped standing on it and started owning it. Forever. That's the whole game. So go back to the two guys from the start, the ones who began on the exact same Monday. The split was never intelligence. The genius blew up. The survivor sized his risk and lived long enough to climb. And every rung on this ladder, runner to owner, came down to one question I've been pointing at the whole time. Are you getting paid for your hours, your results, or your ownership? Effort fills the floor of the ladder. Assets quietly collect everything that effort produces at the top. Here's the honest version most finance videos hide. You probably won't run a fund. The survivorship is brutal, the blow-up is real, and the beach house is rare. But the lesson scales all the way down to wherever you're standing right now. Stop selling only your hours. Find the smallest piece of ownership you can get your hands on and start there. The market was never going to reward how hard you worked, only whether you owned a piece of the outcome. Start owning. Feed the snowball.